Thank you, Professor Martin, and thank you also to CEDA for the opportunity to talk to you today. Presentations on current economic issues facing the Asia-Pacific region invariably comprise seemingly never-ending PowerPoint slides demonstrating every dimension, not of the region per se, but of the inevitability of the rise of China's economy. The slide's sometimes a bit like Alan Kohler on the ABC News. You look, that looks quite interesting. It's gone. So from that point of view, then, the problem of presentations like this one is that the numbers are of such a magnitude that they tend to lose their meaning and impact. You know, as with fiscal debt, billions, even trillions, can sometimes cease to convey the true value of a growing trade and investment relationship, be they bilateral or multilateral. And in any event, Warren has covered some of the key numbers and trends for us today, so I'll try to talk about perhaps issues rather than numbers. Firstly, let's look briefly at some of the current issues likely to guide the future direction of the Asia-Pacific region, geopolitical but especially economic. Secondly, China's domestic challenges. And thirdly, and I can't resist this, of course, the state of the bilateral relationship between Australia and China, encompassing both trade and especially investment. So, China in the Asia-Pacific region. China is the major trading partner of over 100 countries worldwide. So, that is, countries which count China as their largest trading partner. Of course, many of those countries are in Asia, be it in Central Asia, countries like the Stans, Kazakhstan, Uzbekistan, etc., the Pacific Rim, and the economies of Southeast Asia. These are economies, the health of which will increasingly stand or fall according to the performance of China's economy, both real and indeed perceived for the future. As China's economy becomes increasingly more sophisticated, it's not or no longer cheap Chinese labour which drives the relationships. If anything, it's becoming China that's looking for cheap labour itself in countries like Indonesia and Vietnam and so on. But modern manufacturing logistics based on multi-locational assembly of component parts also plays a key role in interdependency. And of course, natural resources to feed China's economic growth also drives interdependence. But these relationships between China and its Asian neighbours are increasingly complex. Of course, the nations of Asia and the Pacific are also competitors for natural resources, for example, both as buyers and as sellers. Australia could hardly assume that it will not be affected by China's recent massive gas deal with Russia. And this competition is being manifested in recent times in worrying circumstances by China's claims in the South China Sea. This has already had significant impact on China's relations with Vietnam and the Philippines, serious conflict in the case of Vietnam. Then there are the longer-term ongoing tensions, China and Taiwan, China and Japan, and of course the destabilising effect of North Korea in the region. All of these issues have potential to create serious waves in the region's economic growth story. And of course, overhanging all is the crucial relationship between China and the United States. If we turn to look at economic reforms in China, and Warren has touched on this, China is facing massive challenges: destructive air, water and ground pollution, entrenched bureaucratic inefficiencies, corruption, growing political and ethnic unrest, especially in Western provinces, and demographic concerns are just a few. Many are of a magnitude and scale that would paralyse most countries. The old saying that China must grow rich before it grows old remains true. Within the foreseeable future, the proportion of Chinese people of working age will fall below the proportion who are unable to work. It's not beyond the bounds of possibility, and increasingly we hear this said in conferences such as this, and absurd as it may sound, that China may face labour shortages in the future. Recent easing of the one-child policy is partly an attempt to address this critical issue. China is engaging in ongoing reform to try to address these domestic economic challenges. By and large, reform has been a slow and cautious process. Deng Xiaoping's touching the stones to cross the river. Yet in historic terms, the speed of achievements has been quite remarkable. I recall being asked in the 1990s to help the Chinese government to draft economic laws to assist in the transition from a centrally planned system to a free market economy. The first step was to pass a competition anti-monopoly law, Trade Practices Act, if you will, in the Australian context. At the same time as we were being asked to work on this very, very significant systemic reform, the government was itself consolidating and merging thousands of state-owned enterprises, many of which, has to be said, were insolvent, to create the huge monopolistic enterprises that we have now become so familiar with today. There was a disconnect there. And of course there was no ACCC or other infrastructure to police any new law. In short, there was no way that our work would have any meaningful impact on business conduct, yet it was seen as being a critical step in China's transition to a free market economy. That law ultimately took well over 10 years to come to fruition. Yet, perhaps paradoxically, it's only 15 years ago that I attended a presentation of one of America's foremost economic analysts who, over the course of a 1-hour paper, never mentioned China once in his paper on the global economic outlook. I couldn't resist it, of course, at the end of the presentation. When they called for questions, I put my hand up and I said, "I'm intrigued, sir, you've very interesting presentation, but you haven't mentioned the fastest growing economy in the world once in your global outlook." And he looked at me a bit with some perplexion. He said, "What are you talking about?" I said, "I'm talking about China." "Oh, we don't keep numbers for China," he said. "We don't have any reliable data on China." I make that point simply to stress, whilst things may appear at one level to be moving very slowly, we've only got to look back over 15 or 20 years to see the remarkable transformation that's occurred, not only in China, but in the way the world looks at China. The caution is still there in China. The difference today is that China is crossing that river in so many places at once, and the water is getting deeper and deeper. But it has to be said, by and large, they've done a pretty good job at guiding China's economy to where it is today. Economists say there is no substitute for fundamental changes if China is to succeed in its transformation from that bureaucratically run, pollution-ridden industrial powerhouse to a more balanced market-driven economy. However, reforms such as freeing up bank interest rates or dismantling those state monopolies will cause much short-term pain. I think, again, Warren touched on this, and provide gains only in the long term. With the economy expected to grow at around 7.3% this year, the slowest in 24 years and close to the level Beijing believes is needed to preserve financial and social stability, some of these reforms will need to be postponed. It seems inevitable. China's leaders are, in fact, encouraged by the progress so far, and President Xi Jinping, Premier Li Keqiang have demonstrated strong commitment for a greater role for market competition across the economy. Economic data earlier in the year that indicated potentially worrying weaknesses in China's economy sparked new calls for Beijing to ease restrictive policies to shore up growth. Since November, when Communist Party leaders adopted a reform blueprint for the rest of the decade, no week has passed without new initiatives in areas ranging from the environment, resource pricing, to capital flows, and of course financial regulation. Then there is the challenge of coping with the world's greatest ever transmigration of the population to the cities, providing the infrastructure, the roads, housing, public transport, etc., to cope. Those of us who travel regularly to China continue to be amazed at the way ring roads, subway lines, shopping malls, etc. just seem to pop up in no time. What a contrast to Australia. I think, of course, of Badgerys Creek, for example. We'd still be thinking about it. What it says is that China may take time to introduce its reforms, to think through them carefully, but once decisions are made, the markets do respond quickly. And now, if I have time, I'll just turn to talk a little bit about China's investment in Australia. A few years ago, we organised a conference in Beijing with SASAC, the body that oversees China's major state-owned enterprises. The conference was for senior executives of China's major state-owned enterprises under the title Investing in Difficult Jurisdictions, investing in difficult countries. We talked about countries like Kazakhstan, the Congo, Eastern Europe, and so on. And when we finished, as you do, probably do this morning, we called for questions. And a lady from one of China's iconic oil and gas companies, just down in front of me here, thrust her hand enthusiastically in the air, a bit like a primary student wanting to go to the bathroom, you know. I have one question, she said. Why didn't you talk about Australia as a difficult place to invest? We think Australia is a very difficult place to invest. The scary thing was not just that she asked the question, but it was the sound of the choruses of agreement around the room from these major state-owned enterprises. Why so? Australia is, on the face of it, wonderful benefits for investment. Mature legal systems, very good financial markets and so on. And of course, excellent assets. Chinese state-owned enterprises genuinely believe that Australian governments, particularly over the past 7 years, have discriminated against them. For the SOEs, every acquisition must be referred to the Foreign Investment Review Board, regardless of the value. In market transactions, for example, a potential takeover, this is a huge disadvantage. Nowadays, it's not so much the lengthy delays in obtaining FIRB approvals or even the sometimes unexpected conditions that have been imposed on some of the proposals, but rather the war stories themselves around the projects themselves. For example, the failure of Australia to deliver the Oakajee Port and Railway in the Midwest region of Western Australia, or even allow China to fund and build it, to support the billions of dollars invested by Chinese steel mills to develop new iron ore mines in the region. It's a good example. We are constantly told by Australian officials that China has no problem with the FIRB, and the government likes to quote the high numbers of successful applications by Chinese SOEs, but the numbers can be misleading. Let me put it to you this way. The numbers include, for example, every application made by an Australian company, maybe an Australian listed company even, every application made by an Australian company that happens to have a 15% shareholding by a Chinese SOE, because these companies are deemed by law to be Chinese SOEs themselves. And because they're Chinese SOEs, there's no financial threshold. So every acquisition made by these Australian companies is categorised as an application by a Chinese SOE. Then in terms of the war stories that we hear circulating all the time in China at conferences and such as this and so on, there's the highly public and bitter dispute between CITIC Pacific and Clive Palmer, and the increasingly loud concerns about Chinese investment in our agricultural sector and, of course, in urban residential properties. And if you look at it, China still ranks relatively lowly in nations investing in Australia, especially compared to, say, the United States, which is the top country for investment in Australia. We quote the millions of tourists who we expect to visit Australia over the next 10 years, and hopefully that will be the case. But then the third world infrastructure to support some of our major tourist destinations would dissuade the most committed of tourists. Try navigating the deep potholes on the Great Ocean Road on the way to the 12 Apostles in Victoria. Thousands of tourist buses share that iconic road every day with logging trucks and milk tankers. It's dangerous and it's a disgrace to our tourist industry and infrastructure, and it will have an impact, along with the many other projects around, many other tourist destinations around Australia, on attitudes formed by Chinese tourists visiting Australia. Australia must face the fact that there is global competitive demand for Chinese capital, and many of their investments around the world will come online in coming years, and I think of Africa in particular, to reduce China's dependence on Australia's resources. Australia is no longer China's #1 investment destination. That is now again the United States. Australia has many investment attractions, but we cannot continue to be complacent. Thus far, China has shown itself to be receptive to the Abbott government's open for business mantra. But to be sustained, we will need more than words. On the positive side, this week's strategic economic dialogue in China involving Australia's Trade Minister, Rob, and the Treasurer will focus on making really tangible progress on an FTA with China in time for the G20 meeting later in the year. And the dialogue talks this week on the creation of a clearing and settlement centre for RMB in Sydney is a welcome move. We've been negotiating this FTA for over a decade, and if we are to obtain greater access to China's valuable agricultural markets and financial services sector, we may need to give way on some restrictions we currently place on Chinese investment in this country. So finally, in summary, as with the recently finalised trade agreements with Japan and South Korea, a free trade agreement could prove to be of inestimable value to the Australian economy in the future. Already, the Australia-China Business Council's China Trade Report finds that each and every household benefits to the tune of over $14,000 per annum from our trade with China, $14,000. With careful management, those benefits hopefully may have only just begun. Let's hope so. Perhaps we might pause there. Thank you very much again for the opportunity to talk to you.